Hi guys, in this video we will talk about investing. What is investing? How can you start investing? Investing is the process of buying assets that increase in value over time and provide returns in the form of income payments or capital gains. In a larger sense, investing can also be about spending time or money to improve your own life or the lives of others. But in the world of finance, investing is the purchase of securities, real estate, and other items of value in the pursuit of capital gains or income. How does investing work? In the most straightforward sense, investing works when you buy an asset at a low price and sell it at a higher price. This kind of return on your investment called a capital gain. Earning returns by selling assets for a profit or realizing your capital gains is one way to make money investing. When an investment gains in value between when you buy it and you sell it, it's also known as appreciation. What are the basic types of investments? There are four main asset classes that people can invest in with the hopes of enjoying appreciation: stocks, bonds, commodities, and real estate. In addition to these basic securities, there are funds like mutual funds and exchange traded funds that buy different combinations of these assets. When you buy these funds, you are investing hundreds or thousands of individual assets, stocks. Companies sell stock to raise money to fund their business operations. Buying shares of stock gives you partial ownership of a company and lets you participate in its gains. Some stocks also pay dividends, which are small regular payments of companies' profits. Because there are no guaranteed returns and individual companies may go out of business, stocks come with greater risk than some other investments. Bonds. Bonds allow investors to become the bank. When companies and countries need to raise capital, they borrow money from investors by issuing debt called bonds. When you invest in bonds, you are loaning money to the issuer for a fixed period of time. In return for your loan, the issuer will pay you a fixed rate of return as well as the money you initially loaned them. Because of their guaranteed fixed rates of return, bonds are also known as fixed income investments and are generally less risky than stocks. Not all bonds are safe investments, though. Some bonds are issued by companies with poor credit ratings, meaning they may be more likely to default on their repayment. Commodities. Commodities are agricultural products, energy products, and metals, including precious metals. These assets are generally the raw materials used by industry, and their prices depend on market demand. For example, if a flood impacts the supply of wheat, the price of wheat might increase due to scarcity. Buying physical commodities means holding quantities of oil, wheat, and gold. As you might imagine, this is not how most people invest in commodities. Instead, investors buy commodities using futures and options contracts. You can also invest in commodities via other securities like ETFs or buying the shares of companies that produce commodities. Commodities can be relatively high-risk investments. Futures and options investing frequently involves trading with money you borrow, amplifying your potential for losses. That's why buying commodities is typically for more experienced investors. Real estate. You can invest in real estate by buying a home, building, or a piece of land. Real estate investments vary in risk level and are subject to a wide variety of factors, such as economic cycles, crime rates, public school ratings, and local government stability. People looking to invest in real estate without having to own or manage real estate directly might consider buying shares of a real estate investment trust. Um, REITs are companies that use real estate to generate income for shareholders. Traditionally, they pay higher dividends than many other assets like stocks. Mutual funds and ETFs. Mutual funds and ETFs invest in stocks, bonds, and commodities following a particular strategy. Funds like ETFs and mutual funds let you invest in hundreds of or thousands of assets at once when you purchase their shares. This easy diversification makes mutual funds and ETFs generally less risky than individual investments. While both mutual funds and ETFs are types of funds, they operate a little differently. Mutual funds buy and sell a wide range of assets and are frequently actively managed, meaning an investment professional chooses what they invest in. Mutual funds often are trying to perform better than a benchmark index. This active hands-on management means mutual funds generally are more expensive to invest in than ETFs. ETFs also contain hundreds or thousands of individual securities. Rather than trying to beat a particular index, however, ETFs generally try to copy the performance of a particular benchmark index. This passive approach to investing means your investment returns will probably never exceed average benchmark performance. Because they aren't actively managed, ETFs usually cost less to invest in than mutual funds. And historically, very few actively managed mutual funds have outperformed their benchmark indexes and passive funds long term. How to think about risk and investing? Different investments come with different levels of risk. Taking on more risk means your investment returns may grow faster, but it also means you face a greater chance of losing money. Conversely, less risk means you may earn profits more slowly, but your investment is safer. Deciding how much risk to take on when investing is called judging your risk tolerance. If you are comfortable with more short term ups and downs in your investment value for the chance of greater long term returns, you probably have higher risk tolerance. On the other hand, you might feel better with a slower, more moderate rate of return with fewer ups and downs. In that case, you may have a lower risk tolerance. So guys, we will end this interesting video. Goodbye.